right. So hi everybody. This is a interesting topic with no right answers. We have a great panel here, and I think we're going to cover the E, S, and G, which is kind of rare because you hear mostly about E. So what I'm going to do, let me introduce myself, and then I'll have the panelists introduce themselves. I'm a partner at Thompson Hine in a law firm in the DC office. I heard people earlier talking about their, how long they've been involved in the ETF industry. Well, I was there when the first exemptive application came in at the SEC, and so it's hard to beat my longevity. And luckily, that SEC, not this SEC, that SEC said, yes, hey, we'll take a chance on this product. And it's worked out pretty well. So why don't we do this? Let's just go down the line, and please introduce yourself and your firm. And if you want to mention anything about ESG now, you can do it as well.
Hi, everybody. Appreciate you all sticking with us in the afternoon. I'm George Altman. I'm with Vets Indexes. And our focus on ESG is on the social and governance benefits of companies making efforts to recruit, hire, and then retain and develop into senior leaders, military veterans.
Hey everyone, Matt Cole. I head up the investments at Strive Asset Management. We launched our first ETF about 3 months ago. Currently have over 7 ETFs, over $500 million of AUM, with a differentiator around corporate governance. So similar risk, return, fee to many of the large asset managers out there, BlackRock, State Street, and Vanguard. But when it comes to corporate governance, we give a mandate to corporations to focus exclusively on excellent products, excellent services for their customers over any social or political agenda. We believe that that's our role as a fiduciary to our clients to maximize long-run value. And when we look at the ESG movement today, I would say that it's gone away from what I would say it should be from a first principles basis. And I think that that's been value destructive, not value additive to corporations. And lastly, I would just say that many of the people on the panel with me, I think, are taking more of a true first principled approach, but I think that they are in the minority of the overall ESG movement.
I'm Julie Kane, the CEO of Democracy Investments. Our Democracy International Fund ETF uses the Economist Democracy Index to very neutrally and systematically tilt an all-world ex-US portfolio towards democracies and away from authoritarian states. We believe ESG is a very well-intended movement, and we also have a strategy that allows investors to vote with their dollars.
Hi, Anthony Cecine, Senior Investment Strategist, Model Portfolio Manager at CraneShares. We're a China and climate-focused ETF company. For those of you who doesn't know, CraneShares 2013, we launched our first fund, KWeb, to China Internet. 2015, we were the first firm to give international investors access to mainland China. And in 2019, we launched our first carbon ETF, first globally, and started going more into climate. And then after that, as a firm, as we started growing, we started to improve our policies internally to become part of the firms of the future. And part of that was becoming PRI signatories, focusing more on climate, building kind of a climate suite that goes with a carbon fund that we built in 2019. And also as investors in China, starting to help companies in China move more closely to ESG, trying to let them know, being in ESG, doing what you need to do in that space will actually ultimately bring you more investors and more money to your companies. And that's something we're starting to hear resonate even more and more.
Thanks, everybody. And I think everybody in the room knows that ESG is not new. There's been social responsible funds for a long time, Calvert's, Parnassus, various religious funds. And also, I think it's always been part of portfolio management as well. When you're analyzing a company, and obviously, years and years ago when the tanker hit spilled oil in Alaska on pristine islands, I mean, that's a risk. So I don't think it's anything new. However, the amount of attention it's getting is certainly new, and I think it's led by this movement. There's a lot of young people that are interested in investing and picking in eliminating companies they don't want their money invested in, and then kind of bringing it up to the SEC. Obviously, with climate change, the Biden administration. To my knowledge, when they were talking to the SEC, the only thing they said was the main thing is pass ESG rules, both in the fund industry and the corporate industry. So it's definitely now in the forefront. And I mention young people because there are surveys out there that say young people are willing to give up alpha, to avoid certain companies. That's not true for my generation. But with that said, maybe Anthony, you can talk about, are you necessarily giving up alpha by layering on ESG filters or strategy, or can you go out there and obtain alpha?
Thank you. Great question. And it's a good place to start because when you're focused on investment, ultimately you're focused on alpha. Now, research suggests that, if ESG companies tend to perform better for many reasons, right? Maybe a little bit over last year, that was a little bit different because the war in Ukraine, we saw energy prices go up and some of these portfolios do a little bit better. But in general, over long term, ESG companies do better. So the way we approach our investment is first investment. Second, ESG is a good thing to do, in our opinion, for the long term. And if you look at it, you can look at it from multiple directions. As I mentioned, one is the research that shows that ESG does better, and two, in a specific environment like this, because of all the support that we're getting from governments, from consumers, the ESG, or specifically climate-related investments, now have a differentiated alpha, differentiated risk from the rest of the market, right? So you're seeing, if you look at carbon investment, you look at electric vehicle investment, you look at decarbonization investment, these are not as much driven by what's happening in the market with regards to rates. They are, of course, but not to the extent you see in other industries, but they're actually driven with internal dynamics, right? The Inflation Reduction Act is giving Ford $20 billion and GM to retool their factories from ICE to EV. So these two companies do not have to go to the bank and ask for loans at high interest rates to do that. They're getting it for cheap from the government. If you go buy an electric car today, you get a $7,500 subsidy immediately on the spot, right? So these type of regulations that we're seeing in the US, in China, in Europe, are helping these industries develop a very differentiated source of alpha and diversification, low downside capture to global markets, lower correlation than the rest of the investments.
I would just say that getting to know these individuals a little bit over the last couple of weeks, that they all have interesting stories that have outperformed. ESG beta, though, I don't think there's good research that if you just invest in the overall market of ESG that there's outperformance or sustainable outperformance. I would argue that what the data has shown so far is it biases to an overweight to the US tech sector that did really well up until about November of 2021 and now has done really poorly. Is it because ESG outperforms or is it because ESG underperforms? I'd argue neither. It's been as an industry, a sector bias by and large at a higher fee than not investing in that sector bias. But within ESG as a whole, there are probably pockets of alpha, but you need to be really careful as an investor where you invest. And I would say that the general mandate as an advisor is to maximize return, period, not maximize return and try to do something with regards to ES or G unless your client directly tells you to. And I would say that that's probably the minority of clients currently.
So VETS Indexes represents a very unique and I think often overlooked part of ESG. Our investment thesis when kind of putting this together is really based on the premise that veterans are a very talented human resource for corporations to lean on, both with soft skills. These are folks who, were in charge of hundreds of millions of dollars, perhaps in government equipment, literally the lives of their fellow service members at a very young age when, some of the rest of us may have been rushing fraternities and having fun partying. They learned responsibility, stick-to-itiveness, tenacity, teamwork. Our theory was that these folks would ultimately benefit the bottom lines of the corporations that hired them based on, not just those soft skills, but the technical skills as well, a lot of which carry over very well from the military to the private sector. I would encourage you all, we have a booth, Vets Indexes does, with our fact sheets, and I'd encourage you all to come grab one, but bottom line, the performance numbers have very much confirmed our investment thesis. We have, since being established in 2018, annually we've outperformed the S&P 500 by a few hundred basis points each year with actually a lower risk profile. Obviously, 2022, this is a different year, a down year. While the S&P 500 has been down something like 24-25% between the start of the year and Q3, we're down, VetsX is down about half of that, about 12-13%. I would say the numbers have confirmed our theory, and, to get back to your question, I do not think that, at least in our case, the ESG focus is in any way an impediment to Alpha. I think it actually drives it.
Yeah, as a former naval aviator, I'm a huge fan of your strategy, George. Thank you for putting that together. And interesting, you're the S and the G. Here we've got the E. I like to point out with our strategy, you could be laser focused on one particular and then overlooking something broad-based, such as what if you are laser focused on E and you are investing in companies that use forced labor to create those wind farms and solar panels? Is that still ESG?
Well, yeah, and I think that gets to an interesting topic because E, S, and G means something different to every person. So I think that's probably a challenge. Now, some of the states have said, and I think there's 18 that wrote a letter to the SEC opposing the ESG rule, and in that letter they said that an asset manager can't fulfill its fiduciary duty, or it's violating its fiduciary duty if it considers ESG factors. Do you have any reaction? I'm looking at you, Julie. Do you have any reaction to that?
Well, as you said, it's very personal, and each generation has a different level of interest in this area. And I would say the millennials and Gen Z, they want both. So how is that? How are you following your fiduciary responsibility if you're not doing as they ask, which could be, yes, I want my dollars touching what I believe in?
I would just say if a client directs you to go in a certain direction, then you have a mandate to do it. And even if that's in a way that doesn't maximize return, the client has given you that mandate. I think at its core with these attorney generals, they were concerned that what I'll call corporate ESG, which is different than first principles based ESG, is value destructive and shouldn't be considered in a client's portfolio unless they've mandated you to do so. We did an exercise where we tried to identify all the important risk factors, because oftentimes people say, well, ESG is just risk factors, and I agree with that. And any investor in part of their overall mosaic of how they think about risk in a portfolio should consider every single risk factor. But I'd say for most active managers, we identified 30 different risk factors, and I would say the E and the S are probably closer to 29 and 30 than 1 and 2, but the asset management industry has tried to put them in the top 5, and I think that's a fiduciary breach.
I mean, companies can do whatever they want, right? And they can choose to invest in ESG or non-ESG, and then whoever invests with them is actually buying into that a specific theory, right? Some companies believe it's part of their own social responsibility to direct money to the companies that are doing good, right? That also are a good investment. So this is important, right? And in my opinion, it's a little bit divisive, and you have people on both side of that aisle. But one thing is very important here is how to implement ESG, right? And it's very important here because the transition to ESG should happen, I think. And in the next 5 to 7 years, you're not going to have ESG or non-ESG. Everything will be investing in an ESG manner. I think we're heading that way. But the question is, how do you make that transition, right? And we have to be very responsible with that transition, in my opinion. Otherwise, we're going to have political backlash. We're going to leave people behind, just like we did when we pushed the coal industry out of Pennsylvania and Michigan, right? We end up with political ramification, just like shortages in China recently, right, from the coal side, because they pushed too much cleaning, just like now the energy crisis in Europe. So you kind of have to find a way to implement that ESG over long term while balancing the urgency of climate, of the danger we're facing over the next 20 years, but also with the livelihood of people that in our economy, in our in our system. So I don't think ESG is a bad thing. I think it's a good thing. We just have to balance it. And based on that, research shows ESG has done better, right? That's also another added responsibility for us to look at these investments. By the way, Julie, we do both. We do E, we have ESG as well. And Matt, if you look at the S&P 500 ESG fund, it has a lot of ExxonMobil and a lot of oil companies in the top 10. It's not just tech.
But no Tesla, right?
And no Tesla, which is crazy, right? So we have an electric vehicle fund, and one of the things that probably we're going to get to the screening question in a little bit, you don't have Tesla, but you have ExxonMobil. How do you justify that?
Just briefly on screening, I think it's interesting what's happened over the last week with regards to screening from FactSet with regards to FTX and ExxonMobil. If you're on social media at all, you might have seen this where FactSet gave FTX a higher rating when it comes to leadership and governance than ExxonMobil. Okay? Why? Well, first off, let's say, okay, forget the fact that their founder committed fraud and possibly going to prison, but maybe they wouldn't be able to realize that. But FTX was a private company. It had a board of 3 individuals, SBF, 1 FTX employee, and a lawyer. Chamath Palihapitiya was considering investing in their last round and recommended that they put investors on their board. And the response back from FTX was, go blank yourself, in his words. Secondarily, the New York Times article that came out 2 or 3 days ago mentioned that investors had recommended more senior executives on the leadership team because they were such a young team. And those investors were shut out from future rounds from investing in FTX. Why did FactSet give FTX such a high rating? Well, SBF was known for effective altruism, being a quote-unquote good guy, and also, was the second largest donor to the Democratic Party. But at its core, FTX himself, there was a Vox article where he said that was all a sham, that he didn't believe in ESG at all. He played the game to get the ESG crowd to like him. And he did so, and so I think that's a good example from FactSet. FactSet's one of the most reputable data companies in our industry that fell for that and gave this company that should have had a horrible leadership and governance rating a higher one than Exxon. I think that's really crazy. I think the fact that Tesla wasn't in the S&P 500 ESG index is crazy. That's where I say corporate ESG, the mainstream ESG, is just value destructive, and investors would be better off to just ignore it altogether.
And I think that's a challenge. So, I saw one statistic. When you look at a company like General Motors, 99% of credit evaluators have the same rating. It's almost a perfect correlation. But when you look at a particular company under ESG, that drops down, I don't know if it's 100 people analyzing it, drops down to like 2/3. So it's not even close. And you also have kind of a push-pull going on. You have a lot of asset managers whose potential clients are demanding ESG products and bringing them up in RFPs. And then you've got an industry out there that sees opportunity to make a lot of money selling ESG type rankings. But do you think, and any panelist can jump in, do you think that's a problem, that the data out there, just kind of what you articulated? And
I'd like to take this, and I definitely recognize the importance from what you were saying of making sure your measures to determine, is the governance really good, or are they just kind of saying the right things to the right people at the right time? How you are evaluating companies matters a lot. At Vets Indexes, we do this with a really detailed, kind of lengthy survey that goes very deep into companies' recruiting and hiring practices, companies' development and retention efforts related to veterans, their policies and culture. We've got a 65-question survey. It's actually not just 65 questions. We've got a lot of sub-questions. We go to several hundred metrics, depending on how you're counting. And we get really in-depth in determining the extent of companies' efforts to hire veterans, and most importantly, I think, not just the inputs, not just what they're trying to do, but the outcomes, the actual results. Not just how many veterans are you hiring, what's the proportion of your overall employee population, but are they sticking around, or are you just hiring a bunch and then they're going right out the revolving door? So we take the evaluation part of that very seriously, and I think that's a necessary component of any well-run ESG-focused fund.
And for our methodology, we use the Economist Democracy Index, and there are 60 different indicators that flow up into themes such as electoral process, functioning of government, political participation, and civil liberties. And we believe that ESG should be thinking more broadly about geopolitical risk. And where is the D in ESG? We're sort of the big G for government that is not currently a filter in most ESG strategies.
Well, definitely we have work to do with regards to ESG definition, right? There's work to do. We don't have a unique, or we don't have a one definition for ESG. Everyone has its own. Use different screening services, Sustainalytics versus MSCI versus others out there, and they have different definitions, right? S&P decided to kick out Tesla, right, because their score on S was terrible, and G. But we manage our fund, electric vehicle fund, through BNEF, Bloomberg New Energy Finance, and through Sustainalytics Screen. And they sent us a report, and they said, we recognize that Tesla has done something really bad with regards to social and governance, and we're hoping they're going to fix it, but they also have done something really extraordinary on the E side, right? So as of now, we're not kicking them out, and as a firm, we sent them a letter to kind of fix that. So definitely we need one definition for ESG. Now we're working through SFDR rules. I don't know if you guys are working through that, familiar with that in Europe. A couple of our funds are designated Article 8 in Europe, which is basically for ESG. It's kind of one of the highest ratings you can get. But now it's under analysis, and we're working with companies there that help us through the process, and themselves they're not ready for it. Right? The process is not ready to actually answer all the requirements. So we have work to do with that regard, and I think we're going to make advancements over the next few years. And I think one incident with FTX, it's not, that doesn't mean we should abandon ESG. We're moving through that process now, and at some point, hopefully, with the SEC and EU and China and we'll have one definition, one specific requirements on what a firm should be doing or striving as, they run their business.
I don't think we ever get to one definition and think one definition of anything in any space, including the investment management space, is a dangerous place for us to go. There's differences of opinion in this room on all these different issues. Our fiduciary duty, everyone's fiduciary duty in this room, is to maximize return for their clients, period, unless a client gave it order to you otherwise. I think that the corporate ESG movement has been value destructive. I do, and I think that you can find pockets of alpha within that, but that data, in my opinion, is very biased, and it's conflicted in a similar manner to maybe how the rating agencies S&P, Moody's were conflicted and at odds during the Great Financial Crisis and led to issues like the FTX thing. You have to look at the underlying incentives here, and I think that you shouldn't just ignore the FTX example. There's several examples that we have of engagements that we've had with corporations where shareholder mandates were imposed on them against the direction or against the recommendation from the board of directors by the large asset managers like BlackRock, State Street, and Vanguard. We've engaged with them publicly. We've spent a lot of time in research in these areas and are taking a very specific approach to how we engage with these companies. Like as an example, when it comes to emissions in our engagement with Chevron, we didn't talk to them about scope 1 and scope 2 emissions. We won't get into that today. We only talked about scope 3 because we thought that was where it was value destructive and not in the best interest of shareholders. Yet the large asset managers forced it upon Chevron against the board of directors' recommendation.
In picking up on that, Matt, so a lot of focus is just on screening and which companies are in a portfolio and which companies are not in a portfolio. I think less focus is on activists or engaging, also proxy voting. So what is your firm's approach in both those areas?
Yeah, so we take a 360-degree approach to corporate governance. Proxy voting is just one part of an overall corporate governance strategy. Corporate governance includes proxy voting, putting forth your own shareholder proposals, public engagements, and private engagements. And we'd argue that the majority of change through investors and investor relation boards and corporations happens through engagements, public engagements and private engagements, and actually threatening or putting forth the proposals. The last thing is the proxy voting. And it's one of the things that really concerns me about where the industry is heading, where you have some of the large asset managers now moving towards potentially offering the votes back to the clients while still retaining custody of the assets. There's a saying in the crypto community, not your keys, not your coins. I'd argue that in the asset management industry, it's not your assets, not your corporate governance policy. So if someone else is going to be a manager on behalf of your clients, you better trust the entirety of their approach to corporate governance, because that AUM still sits with them, even if you vote, and even the voting side's really hard unless you have a team to do that yourself.
We use screening for a couple of our products, that have ESG in the name. Cars, which is electric vehicles, and China ESG. They're used for, to make sure that the companies that we include in those funds are in line with what we're saying in the prospectus and in line with the mandate of the fund.
So one of the catalysts, I think, of the SEC rule, and really the other part, has been the active enforcement and inspection area of firms that are either have ESG in the name or it's a big part of the strategy, has been greenwashing. The SEC has suspected that there have been certain firms that, for marketing reasons, have put ESG in the name, but they haven't done the diligence like these firms do. Any of the panelists have any views on greenwashing and how pervasive it is out there? Or?
I mean, we definitely need a definition, right? Because otherwise you end up with a fund that has ExxonMobil but no Tesla in it. And the reason is very simple. It's just about the methodology, right? When you don't have a specific definition, anybody can look at ESG from their own angle. And from some index providers' angle is we look at the ESG on a sector basis, right? So you look at the auto sector and you rank the top within the ESG and you pick those. But then you go to the oil sector and you pick, or energy sector and you pick the, but that's almost like not equating the emissions of the energy sector with the emissions of the automotive sector, right? So many people would think that this is a wrong approach, right, to looking at ESG, because ESG ultimately is the goal from that is funneling money to the people who are doing the right thing, right? And when you look at it from a sector perspective, you're just not equating the emissions across the board. Also, in addition to that, what about the companies that are making a change, right? So we have a fund that invests in decarbonization, and there's a couple other firms that are doing the right thing. And these are basically, if you want, dirty companies today, but they're making huge investments and huge commitments to move in the other direction, basically investing in hydrogen or other renewable energy. Like, these guys are trying to do the right thing. Should we not also give them some credit within that definition?
Sure.
And then with the screening, stepping back and looking at incentives, what are you incentivizing in all of these different approaches and systems? So we chose for our first product to just neutrally tilt, not screen any country out, so that as we get larger, every country will be incented to improve their democracy score to get more capital. When if you draw the line somewhere and then they improve, like, when do you decide to let them back in?
We're trying to shift the conversation where it's been in the last year from greenwashing to what we call green smuggling. And green smuggling at its core is if you just buy any generic passively managed equity ETF, or sometimes even the active ones, that with that you get ESG corporate governance. That disconnect was not something that the average investor signed up for or were aware of. And I think it's become very clear to us as we've talked to CIOs at very large institutions that they had no idea about how some of these large asset managers have been engaging in the corporate governance. And that, what we call greenwashing, I think is where, not green smuggling, is where the debate needs to shift. With greenwashing, I think transparency and openness about what you're doing will solve most of the issues, and people can decide if they think it's a worthy cause or not.
I'll go off the script a little bit, so I'll make the panelists nervous. But you all have a product and that's well defined, and there's a lot of passion behind it. How do you find investors out there? We talked a lot about distribution earlier and the challenges these days, and broadly speaking, the tools out there. But what have you found are successful ways of reaching the audience you want to reach?
So for us, it helps to have our co-founder, Vivek Ramaswamy, who's literally on CNBC, Fox, writing WSJ op-eds every single week. That has helped tremendously with distribution, and we have a full distribution team at Strive that, frankly, we've had so much demand from our clients that they're demanding from their advisors to include us as part of their portfolio. So I think it's been a unique problem, a good problem for us, where it's been more just getting on the platforms and being available for clients, and then for RIAs to give their clients choice at a bare minimum of, if you don't like the corporate governance policy of the large asset managers, there's an alternative, and we're happy to include that as part of your overall portfolio. And that's been part of our product rollout, is to kind of check off passive products to meet the core beta needs of most everyday investors.
I mean, for us, I think we're still trying to crack that code. It's a challenge that we face because, you can see up here on this stage, there's kind of a raging debate focused a lot on the E. Our particular section of it is kind of forgotten, kind of left out. And I think, it is important and, would be useful, kind of broadly applicable, to take a broader view of ESG, and one that, kind of tries to step back from the political food fight that, it often envelops everything in our country. For Vets Indexes, veterans are one of the very few issues where there is no other side, right? There's no one who's anti-veteran anymore. Maybe, a few decades back after the Vietnam War was a different environment. Today, I don't care if you're left, right, center, everyone supports veterans. And, I think moving toward ESG investing that represent kind of broader values rather than something that, is enmeshed in the ever ongoing political food fight could be beneficial.
Yeah, that's why our fund is ex-US as well. I think we're also a bipartisan strategy, and I think Bruce summed it up really well this morning. The challenge for any small fund, and if you're a new category, it's hard for people to get their head around. So we've been getting momentum with people who share our mission, share values for democracy, and focused on impact investing, and I think forums like this. Thank you, ETP, for hosting us.
So we do it by being very focused and provide value for our investors, right? So, and then also by having great sales force, who's with great connections and really active research team. So basically, we're very focused on China and climate. These are our focuses, and we have some also unique alternatives. A lot of our products are very unique, lower correlation to the global markets, not very covered, especially from a research perspective. So we do a lot of research, we dig deep, we build connection within these asset classes, and we build internal teams that becomes expert, right? We have our CIO, Brendan Ahern, who's always also on TV. We have a large strategy team, also through marketing, and it depends also market environment, right? Over the past 2 years, China has been a very, controversial place, so people needed to know what's going on, and we were the source, for investors. And also with regards to climates, now we're becoming the source for carbon, becoming the source for electric vehicles, decarbonization, in addition to other firms as well.
I'll pause here. Anybody have any questions for the panelists at this stage? So feel free to interrupt or raise your hand anytime. Anthony, I'll go back to you on the E part. And under the SEC rule, which is quite onerous rule proposal, if anybody has read through the release. But one part of the rule is that if you are using ESG in your name, and on the environmental side, you would actually have to look at your portfolio, gather data on the greenhouse gas emissions of each portfolio security, somehow aggregate that and come up with an average, and then report that in your semi-annual and annual reports. Just any kind of initial reaction, is that onerous, or is that something you think there'll be a service out there that'll be able to crunch the numbers for?
It's definitely a regulation down the pipeline is pretty heavy with regards to not just ESG, but also marketing. And we've been, for the last month, very busy just applying the new marketing rule, as probably many people here in this room. And with regards to ESG, we're definitely on top of that. We're definitely enhancing our internal processes to kind of meet these upcoming regulations. I don't think it's going to be hard for companies to be able to count their emissions. I think in Europe, they're already doing that. But the question here is, what's the penalty, and how do you deal with companies, and especially in different economic cycles? That's why we think carbon prices is the tool to use, with regards to these regulations, right? As you tighten regulations and tighten emissions on whether cars or your industrial production, you're going to have to, get carbon allowances for that, and that's going to push the prices higher. Europe is a little more advanced with that regard, but the U.S. is right behind. California, carbon allowances are very, very now popular right now, especially with the recent regulation from Governor Newsom. So it's going to take, we have a compliance team and legal team that are literally working 24 hours to make sure we're complying with all this. For us, we're still on the smaller side, but one fun fact I would share with you here, our carbon business, actually, we did the analysis. It offsets all the carbon emissions from New York City, which is a very cool fun fact that we received. But it's gonna be on different companies. It's just how do you implement it, and in different economic cycle, we're seeing now Europe going through that.
Yeah, I'm getting the impression that if you're an advisory firm and you just want to kind of wade into the ESG space, that it seems like you're going to need some dedicated resources and task a person, not just from hearing the amount of work that goes into your portfolio decisions or index decisions, but also on the other side, the activity by the SEC and in looking for people to back up their disclosure. What's the old crystal ball? What do you see ESG, where it's going in 2023 and how it's evolving? I'll just throw it open to the panelists.
I think we're going to move to an industry that's going to become more transparent, that all asset managers, the large asset managers, Strive, everyone will have to be open about all aspects of their business, from corporate governance to their investing strategy. And as an advisor, I think it's going to move towards true fiduciary duty of maximizing returns for your clients, period. I think there are a younger generation that wants ESG, that wants a more active role of doing good, but I think that's a minority of people. There was a poll, Brunswick poll a couple of years ago, and it asked two groups of people a question: do you think corporations should be active in today's social and political issues? The managerial class, which is probably, it's me, it's probably many people in here, 2/3 of them said yes, it's really important, our clients are demanding it. 2/3 of Americans said no. And so it is true that there are some people that are demanding it, but we have to remember what our fiduciary duty is, and if we move away from our fiduciary duty, I think we put ourselves at risk. And I think that, as you know, we obviously are a very politically divided country, but I think where the wind's moving is back to the center.
I think the millennials and Gen Z is even more angry at the state of the world. So as their investments become more powerful, we'll see shifts, and I think we'll see faster movement in Europe and the Nordic countries as well.
Yeah, I don't see ESG just going away, and I think we have the opportunity to, again, kind of take a broader view of it, and I think your note about transparency. It's very important. If you just slap a label on something and declare, I'm environmentally friendly, socially conscious, that's all well and good. That's fine. But back it up. Where's your data to back it up? I think that's important.
I think in the short term, we may move a little backwards because, recession, Europe situation, backlash. But in the long term, it's happening because I think the public opinion wants it to happen, right? Like, think about a company that does the wrong thing. It comes out on the news, how many sponsors they lose, how many, investors they lose. It's this world is very geared now towards doing the right thing, right? Whether it's the right thing or not, but look at Twitter now. By just sensing that Elon Musk may allow certain type of speech on the platform, we're starting to see companies back away from spending advertising money, right? And that's also going to incentivize companies to move more towards ESG because that's going to impact their bottom line. Carbon prices going up is also going to incentivize companies to do the right thing, to decarbonize and to find ways. Finally, we're seeing now Ford and GM actually putting real effort in making a switch to electric vehicles. They've been telling us for many years that, that's the strategy, but now recently actually they started taking that personally, right? Because why? Because it started impacting the bottom line. So in the short term, we may see a little bit of, pullback, but in the long term, I think that's where we're all moving in that direction.
I just have to say that it almost gives me chills to hear the quote, right thing. And I think that in our country today, the right thing and the wrong thing is the truth is we live in a 51% democracy. And there has developed a corporate quote unquote right thing, but I think that's very dangerous to move down that road. And I don't think that any of us, it's not any of our jobs to define the right thing or the wrong thing. It's our jobs to maximize return for our clients, period. And I think that's where we need to move. And I don't think ESG goes away. I think there are clients that demand it. But I think that right now that's the minority. Even if it moves to 50%, I think there's a lot of room. And frankly, our duty is to get back to being a true fiduciary.
Just a heads up, we have 5 minutes to go. So if you're wondering about whether to ask that ESG question, you've got 5 minutes. But one thing I wanted to discuss, and again, no warning to the panelists, but the ETF as the vehicle to deliver ESG to clients and investors. Obviously the ETFs by themselves have attributes, tax reasons, being able to trade throughout the day. But given the personal connection with investors on ESG issues, do you see a role with SMAs in ESG or personalized indexes where they're able to, call out, the type of things? So one client may call out something different and the other one may keep that in the portfolio. And again, kind of looking to the future, do you see a rise in SMAs in this space?
I mean, this is already happening to a certain extent, where you have, let's say you have a client from the Middle East who wants a Sharia compliant fund, right? So based on a specific index, so you create an SMA that doesn't have gambling, that doesn't have, so it's happening a little bit. Is it going to increase? I'm not sure. I don't think so. I mean, because most people agree, for the most part, on what's the definition. I mean, what broad strokes and what's the definition or not. But you may have, an investor or an organization or an entity or two that want to exclude certain investments, or maybe if your economy is heavy, oil heavy, or something else heavy, you probably want to exclude that. Create a separate account, but it's happening already. So,
are you guys, any of the panelists, are there any new types of ETF products you're considering that are ESG focused, or are you sticking to your knitting and what you're doing now?
So we're taking kind of a broader view of, types of financial products to link our indexes to. We started off with a few ETFs. We have a UIT now, but I think a kind of broader view for both what ESG is and which types of financial products it can be applied to is our thinking.
So Strive, we're just finishing up our Series A raise, so it's going to continue to keep us really well funded to grow extremely fast. And as we continue to grow, we'll be launching active products in 2023, active bond products, active equity products, and then continuing to expand our suite of passive products so any consumer can have their full investment needs met with a pro fiduciary voice.
So we're not technically an ESG fund, but because we tilt towards democracies, we score well in all the various ESG rating systems because democracies tend to be more ESG focused. And we'll be considering that as we especially look into expanding into Europe and see where consumer demand goes.
Same here with regards to climate. Our angle is climate because it's a good investment. It's a long-term theme for the next 20, 30 years. We have to make that transition. It's happening. And more than $140 trillion, depending on how you ask, is going to be directed for us to be able to meet our climate goals. And that's going to be divided between electrification, renewables, energy storage, energy efficiency, and carbon and other innovative approaches. So we're going to continue to expand on that theme. First, we started with the carbon, and then we moved to decarbonization, and then now we're looking at the commodities that are going to be involved in that long-term transition, right? So we recently launched electrification metals, which is the 6 metals or 7 metals that are involved in electrification, electric vehicles. And soon we're launching the commodities of the energy transition, which include the whole package with regards to metals, carbon, biomass. Natural gas is going to be part of that as well, has to be part of that transition. What else? Polysilicon, graphite, manganese, all these nice names in the chemistry table. And so yeah, we'll be launching that in the first quarter of 2023.
Question at that table?
Just a quick question. Is this essentially large cap and doesn't look at small and mid caps, or does the ESG products that you have, does the ESG products that you have encompass or address small and mid cap qualifications related to ESG? Or is it to any one of you, or all of you, in fact?
Yeah. We're large and mid-cap, developed in emerging markets.
Okay.
So we, our who is included in our index fund is based on our survey, and our survey is open not just to publicly traded companies of all profiles, but even non-publicly traded companies, even privately held companies, even nonprofit organizations, and government agencies. We think it's important to be evaluating, again, we're evaluating organizations as employers. We think it's important to evaluate everyone on a level playing field, regardless of the type of organization they represent. So, all profiles would fit and are found in BETS indexes.
So ours aren't ESG at all. They're not anti-ESG. They're pro-excellence. But within our products, we have large cap, small cap, value, growth, dividend, you name it, sector, you name it, we have it.
It really depends on the data, right? Like, naturally, the data on the small cap are not as and also small cap companies tend to not have the resources to be able to be ESG or comply with ESG. So generally, you kind of gravitate towards large and mid cap, but we go anywhere as long as the data is available and and it's clear that they're ESG.
Scanning the room. Any other questions? Okay. I think we're at the end of our panel. I want to thank our panelists. They did all the work. All I had to do was ask the question, so it was easy. And thank the conference sponsors. It's been a great opportunity.